Thank you. Thank you. Good morning, everybody. Mike, from the bottom of my heart, thank you. That was a very kind introduction. But above all, thank you for allowing me and the IMF to be part of the opening of this fabulous center. I cannot think of a better place to talk about the pursuit of opportunity than right here in the Hall of Dreams. As I look at the world over the decades, what I see is incredible progress, but also unfulfilled dreams. The average person today is much better than the one 30 years ago, but the averages conceal deep undercurrents of marginalization, discontent, and hardship. My former professor of statistics used to say about averages, you can put your head in the fridge, your feet in the oven, your average temperature, would be average, but you will be dead. And what we see is many people in many places, especially the young, are taking their disappointment to the streets, from Lima to Rabat, from Paris to Nairobi, from Kathmandu to Jakarta. All are demanding better opportunity. Here in the US, chances of growing up to earn more than your parents keep falling. And here, too, discontent has been evident, and it has helped precipitate the policy revolution that is now unfolding, reshaping trade, immigration, and many international frameworks. All of this plays out against a backdrop of deep transformation in geopolitics, in technology, in demographics, with populations surging in some places and shrinking in others, and in the mounting harm we do to our planet. What is the result? Exceptionally high uncertainty. Globally, it has shot up and continues to climb. Buckle up. Uncertainty is the new normal. It is here to stay. As we know, next week the world's finance ministers and central bank governors would gather at our annual meeting. Wonderful to see one of our former governors, Treasury Secretary Mnuchin, here. Thank you for joining us today. As you know, this would be a time of very intense engagements, and the most pressing questions will be about the global economic impact of these forces of transformation and the policy turbulence we are experiencing today. So, how is the world economy coping? Short answer: better than feared, but worse than we need. When we met in April, many experts, not us, predicted a US recession in the near term with negative spillovers to the rest of the world. Instead, the US economy, as well as many other advanced and emerging markets and some developing countries, have held up. As our World Economic Outlook will explain next week, we see global growth slowing only slightly this year and next. All signs point to a world economy that has generally withstood acute strains from multiple shocks. So how do we explain this resilience? What made it possible? I would point to 4 reasons. 1, improved policy fundamentals. 2, private sector adaptability. 3, less severe tariff outcomes than initially feared, for now. And 4, supportive financial conditions for as long as they hold. Let me elaborate. First reason, better policy fundamentals and global coordination. In many parts of the world, sustained efforts have delivered more credible monetary policy, deeper local currency bond markets, new fiscal rules, and during the pandemic, and actually Secretary Mnuchin was part of it, swift, decisive, and globally coordinated fiscal action to limit the immediate pain and the lasting scars. Emerging market economies, in particular, have significantly upgraded their policy frameworks and institutions. We just put out a report on progress they have made, quantifying the gains. These economies now perform better when shocks strike than before the global financial crisis. Good policy makes a difference. Second reason for resilience, private sector adaptability. And again, we have seen the public sector moving out from where it doesn't belong, from the economy, the private sector stepping forward, and that is benefiting the world at a time of more turbulence. Just look at private initiative in world trade. Companies have been front-loading import orders in advance of tariff hikes and reorganizing rapidly their supply chains. Corporate balance sheets are generally strong after years of robust profit. Reflexes are quick after the dry runs of shock after shock. Artificial intelligence is becoming mainstream. Anybody in this audience using ChatGPT? Raise a hand. Okay, mainstream. And change is faced as a challenge, but also embraced as an opportunity. Third reason, tariffs, where the shock has not been as large as initially announced. The US trade-weighted tariff rate has fallen from 23% in April to 17.5% now. This is still much higher than it was before. The US effective rate, we calculate that it is around 9 to 10%. In other words, what is collected as tariffs is far above the rest of the world. But the world has been relatively steady this year with very few cases of retaliation. In short, the world has avoided a tit-for-tat slide into a trade war for now. But openness has nonetheless taken a big hit, and the story is not over. US tariff rates keep moving. Trade deals with the UK, the EU, Japan, soon Korea, they have nudged some rates down, while disputes with Brazil and India have pushed others up. And other countries' rates also are likely to move somewhat more. But bottom line here is better than we feared. For reasons, supportive financial conditions. Fired up by optimism about the productivity-enhancing potential of AI, global equity prices are surging. This plus tight risk spreads leaves funding markets generally wide open. And in addition, the dollar's slide earlier this year gives precious relief to non-US borrowers with dollar-denominated debt. So here we have it, 4 factors behind the economic resilience we have seen this year. But before anyone heaves a big sign of relief, please hear this. Global resilience has not yet been fully tested. And there are some worrying signs the test may come. Just look at the surging global demand for gold. Spurred by valuation effects and net purchases, partly reflecting geopolitical factors, holdings of monetary gold now exceed 1/5 of the world's official reserves. On tariffs, the full effect is still to unfold. In the US, margin compression could give way to more price pass-through, raising inflation, with implications for monetary policy and for growth. Elsewhere, a flood of goods previously destined for the US market could trigger a second round of tariff hikes. Yes, world trade is rippling, but still flowing. Like water, it is not easy to pluck and stop. For now, most of the world's trade still follows the rules. We at the IMF are urging the world's policymakers, please keep it this way. Please preserve trade as an engine of growth. As for easy financial conditions, which are masking but not arresting some softening trends, including in job creation, history tells us this sentiment can turn on the dime. Today's valuations are heading towards levels we saw during the bullishness about the internet 25 years ago. If a sharp correction were to occur, tighter financial conditions could drag down world growth, expose vulnerabilities, and make life especially tough for developing countries. So in a multipolar world of rapid change, it is paramount that policymakers do much more to capture and deliver opportunity so they can meet the aspirations of their citizens, especially young people. So how could they do that? At the IMF, we propose 3 medium-term policy goals. First, to durably lift growth, so the economy creates more jobs, more public revenue, better public and private debt sustainability. Second, to repair government finances, so they can buffer new shocks and attend to the pressing needs without driving private sector borrowing rates up.